Hello, everyone. My name is Beth White, Director of Class Giving at Skidmore and a proud parent of a class of 2021 alumna. It is my genuine pleasure to introduce our presenter today, Art Tracy, Skidmore's Director of Gift Planning. Today's interactive session is being recorded and is intended to provide you with information about the many and often simple giving vehicles to achieve tax-wise philanthropy. We invite you in advance for your participation and hope you'll find our brief time together well spent. Art's going to walk through the 6 most common planned giving options, and then we'll have time for your questions. You'll see an option to send questions confidentially via the Ask a Question button. If you're viewing from our Alumni Learning Consortium landing page. We'll do our best to get to as many questions as possible. We ask that you keep your questions general during this session and invite you to contact Art with more specific questions related to your own personal circumstances after this presentation. With that, it is my pleasure to introduce Skidmore's Director of Gift Planning, Art Tracy.
Well, thanks, Beth. I appreciate that. It's my pleasure to join everybody today and give you some general information about tax-wise ways to give to Skidmore and other nonprofits that you care about. We hope you care about us more, but anyway, it applies to all charities. As Beth mentioned, I'd be pleased to visit with you individually about specific questions that you might have related to your own circumstances. Very happy to do that. We've got some slides here to illustrate the concepts that I'm going to walk through. And then, as Beth mentioned, I'll get to your questions at the end. So with that, let's go ahead and begin. So right up front, I wanted to mention that we, Skidmore, again, is going to celebrate National Global Giving Day on November 28th. It's Tuesday, Giving Tuesday. And so it's a day when you can help sort of create a culture of philanthropy with our students. For every donor that we have, we're going to give a cookie out. So we're hoping for maybe 2,000 donors, 2,500 donors. You know, we have about 2,500 students. So please participate in that if you will. We'd appreciate that. All right. So the first slide. The overview on this session, I'm going to talk to you about 3 different categories of giving. One is making an impact now, and there's several ways to do that. Secondly, I'm going to talk to you about different ways to give through your estate. And then the third area, which I'll cover, the final area, will be I call life income gifts, gifts that you can make that will actually generate an income back to you. So those are the 3 areas, and let's go ahead and get started. To make an impact now, I'm going to talk about a couple things. First of all, giving long-term appreciated securities. A lot of people don't think about giving those because they're in their investment portfolio, but there's a lot of good advantages that you should consider, and then maybe you'll want to give this way. I'll just point out, when I say long-term, you own them for more than 12 months. That's what long-term means. And then highly appreciated means obviously they've gone up in value. So if you give long-term highly appreciated securities, it is going to reduce the cost of giving for you because you paid less for that security. So it's just going to cost you less. If you itemize your charitable deductions on your income taxes, you will get a charitable deduction for the full fair market value of your gift. This is a big advantage, and I'll get into specific numbers with you very soon, but you will eliminate capital gain from your portfolio, your investment portfolio. That capital gain represents future taxes for you. And if you can eliminate it, that's a good thing. And when I say eliminate it, you can just use the cash that you would have given to Skidmore, repurchase the security at the higher cost basis, at the current cost. You've eliminated the capital gain. So let's take a look at a real example here in the next slide. Let's compare giving $2,500 in cash versus a stock or a couple shares of stock that's worth $2,500. For the cash gift, it's the cash obviously costs you $2,500. Let's assume you're itemizing and you're in the 32% income tax bracket. You'll get a tax savings on your tax return of $800. So the net cost of that gift, if you give cash, is $1,700. Now, let's say for the stock, you bought that stock years ago for $1,000. That's your basis. And then you itemize just, as in the other example with the cash, your tax savings is $800. So you can see that your net cost is $200. So obviously it's a lot better. But if you look at the little additional check marks down at the bottom, you've eliminated $1,500 capital gain from your portfolio, which means you've avoided $225 in capital gains tax, 15% of your gain. And then you just use your $2,500 that you didn't give us because you gave us a stock, and you repurchase that stock. You've got it at a higher basis. So that is really a win-win all around for you. It's the same gift for us. It doesn't matter to us, but it really is a good deal for you. I'll just point out that these stock gifts or securities, mutual funds, whatnot, they cannot be in some sort of retirement account. You pull them out, then there's all kinds of implications. But these are just stocks that would be in a brokerage account, something like that. Great way to give. Okay, next. Another way to make an impact now will be what's called a qualified charitable distribution. And I know this probably doesn't apply to some people on the webinar today. This is for, first of all, if you have to have an IRA and you have to be at least 70 and a half years old. Now, a lot of people have money or investments in other types of retirement accounts. For example, a 401k, a 403b, so like I have because we're an educational institution. Money that is funds that are in other types of retirement accounts can be rolled over very easy. You just talk to your administrator, can be rolled over into an individual retirement account. And then you can take advantage of this great way to give. You have to be at least 70 and a half to do a qualified charitable distribution. And the key thing about it is that your administrator will arrange for you a direct payment from your IRA to Skidmore. Now, what does that do for you? Well, first of all, when you take money out of your IRA, it increases your income. And so that means, of course, more income tax for you. However, if you do a qualified charitable distribution, the money comes straight from your IRA to Skidmore. Your income does not go up. Well, that's great, but there's another benefit. You also get credit towards your required minimum distribution. And the ages have changed in recent years. The current age is 73 now. So if you're 73 or older, you must take money out of your IRA, and there's a required minimum amount that you can take out. And if you give this way, you'll get credit towards your required minimum distribution. And then that brings me really to the next, nope, not the next slide, sorry, to the next bullet point. You'll see it in big, bold text. This could actually help you with your Medicare Part B premiums, which are income-based. And I'll go through an example in the next slide. But so the maximum amount that a person can do with a QCD or qualified charitable distribution is $100,000 per year. That amount actually is being indexed. And I believe we're going to see an increase in 2024 to that amount. I understand it's going to go up. This isn't official yet, so don't quote me. But I think it's going to go up to about $105,000. So how can taking a QCD from your IRA and giving it to Skidmore help you with Medicare Part B premium? So let's look at the next slide. On this slide, you can see these are the some of the premiums. There's a lot more for higher incomes, but the column on the left is for single filers. The column in the middle is for joint filers, and then you'll see the monthly premium over there on the right side. Now, we're going to look at an example in just a minute of a single filer, and the income is going to be, we're going to show how a QCD out of an IRA, we'll take that filer from taxable income at 124,000 down to 119,000. And you can see on the left side at 124,000, you read over to the far right side, the monthly premium for Medicare Part B is $329.70. Well, if you can reduce that income down to $119,000, you can see that the premium goes down almost $100, $230.80. So let's look at that in the next slide. All right, so we've got Joan. This is an example. Joan is 75 years old, and she makes $5,000 cash gifts to Skidmore every December. Instead of giving a cash gift, if she gives a qualified charitable distribution instead, she'll save almost $1,200 on her Medicare premiums. That's the difference I showed you in that previous slide. It's $98.90 less per month. Well, what does that look like? Well, so you can see on the left side, the sources of income are Social Security, 401k, IRA, and then there's the total taxable income. The middle column, that's her taxable income if she gives her cash gift. It's $124,000. She's got, her required minimum distributions out of the 401k and the IRA, $43,000 each. You add in her Social Security, $38,000. It all adds up to $124,000 in taxable income. And then, as I showed you in the previous slide, her Medicare Part B premium is $329.70 per month. If she instead gives a qualified charitable distribution from the IRA to Skidmore, the IRA income, you can see actually instead of being $43,000, it's gone down by $5,000. It's now $38,000. So that's the taxable income. That and she gets credit for that. That $5,000 counts towards her required minimum distribution. But the taxable portion is not the 43, it's actually 38. So that reduces her income by $5,000. So her total taxable income is $119,000, pushes her down into the lower premium bracket. And you can see her premium is now $230.80. So over the course of the year, it's almost $1,200. And why wouldn't you want to save that? It just makes a lot of sense. So if you're in a situation where you have an IRA and you are having to take distributions, this is a great thing that you really ought to take a look at. Now, I did want to just point out to you again that Joan has a 401k, and she could actually roll that 401k over into an individual retirement account. And if she's giving to other charities, which she might do, she could do QCDs to them, or she could, step up her giving here at Skidmore. We wouldn't mind that either. But I did want to point that out, that she could take advantage even more so by switching that money into an IRA. Okay, next. What are other ways that you can make an impact now? I'm going to talk a little bit about real estate, artwork, horses, and insurance policies. Real estate, we accept real estate gifts. We have to go through a process of, looking at the liabilities. Once we accept a gift of real estate, we don't want to put Skidmore's endowment in jeopardy. So there's some due diligence checks. And generally, to take a real estate gift, it could take anywhere from 6 to 8 weeks to go through everything. We do take those gifts. Artwork for the Tang Museum, we receive that all the time. They have a wonderful collection, and much of it we've received in terms of donations. We have a riding team that's won its national championship, I guess the 9th time, and last year was their 9th national championship. So we have horses here. We actually accept donations of them. There's a process there. And insurance policies with cash value, we accept those. All right. So on estate gifts, I did want to mention this right now before I get into the various ways of giving through your estate. You can actually, most times when people give through their estate, there's some tax advantages to their estate. However, in some circumstances, if you have planned an estate gift, you can actually save some money on your taxes now. And this is in particular for people that plan to pass their real estate or their house to Skidmore or a vacation house. And what it's called, what I'm talking about right here, is called a retained life estate gift. Essentially, the way it works is you deed the remainder interest in your house to Skidmore, and then you retain the right to live there for life. The IRS looks at your home as having two components: the remainder interest after your lifetime, and then your life use interest. Well, you give us that remainder interest now, and then you continue to live there for life. You retain that, and of course you continue paying for all the expenses, taxes, maintenance, insurance, etc. But when you deed that remainder interest to Skidmore, that is a charitable gift, and it's very significant. This is an example for a couple ages 77 and 79 who donate the remainder interest in their vacation home, $500,000 vacation home, to Skidmore. They will save, we're assuming they're in the 32% income tax bracket, they will save $73,000 on their income taxes. Their deduction that they earn by deeding the remainder interest is about $229,000. And they have a total of 6 years in which to use that deduction. And when it's all used and all is said and done, they will have saved $73,000, actually a little bit more, on their income taxes over the course of the time that they use that deduction. They can stay there living in that house for life. And the thing is that the house is actually removed from their estate. It saves their executor time. The executor doesn't have to do anything. And therefore it saves money out of your estate as well. The college actually will be responsible for selling the home after your lifetime. As I mentioned a minute ago, before we accept gifts of real estate, there is a due diligence process that we need to go through. So if you're interested in anything like that, contact me and I can tell you all about that. But this is a great way. It doesn't apply to everybody, obviously, and you need to make sure that your circumstances can allow you to do this. But it is a terrific way to save money and make a gift. And we've done these plenty of times, and they're great gifts. Okay. So for estate gifts, there's a couple important things that I'd like you to keep in mind. First of all, Skidmore has a legal obligation to use your gift as you direct. And so if you plan something through your will or your trust, and we'll get into that in just a minute, and you want us to use it in a certain way, please, by all means, tell us what you want us to do with it. Tell us now so that we can make sure that we're able to do it. If you want us to do something and we can't do it, then we can't accept a gift. So we're legally obligated to use your gift as you direct. So check with us first. For gifts that are not designated, and those are wonderful gifts, and they're really a statement of confidence in the leadership of the college and the direction in which we're going. Those are great gifts. But if they're undesignated and they're under $100,000, your gift would be used for the Skidmore Fund current operations, much of which supports students directly. And if it's $100,000 or over, then the college will decide how to use that, the president and some of our board members. Generally, on those larger gifts, they will either be used for capital construction, and we have a number of projects right now, the McCaffrey-Wegman Tennis and Wellness Center, for example. So it would be used for capital construction, or it will be placed into the endowment, which is sort of our permanent spending account, if you will. Okay, next. So what are the different types of estate gifts? The most common one is giving through a will or a living trust. The only difference between a will or a living trust is that a living trust avoids probate, which is a public process in court, and it's actually, frankly, quicker than giving through a will. The distribution is made much more quickly than through a will. But be that as it may, that's the most common way to give through your estate. And people give either a percent or a dollar amount generally. I think a percent is a great way, because as the value of your estate fluctuates, so will the value of your gift. Whereas if you put a specific dollar amount in there, there could be some complications later on. But your attorney will advise you on what's best to do. But we do receive quite a few gifts with a percent of the estate. A very easy way to give that does not involve a lawyer, and nothing against lawyers, they're great and they add a lot of value, but you can make beneficiary designations without the use of an attorney. And frankly, your will or your living trust wouldn't take priority over a beneficiary designation. These are done with retirement accounts, for example, your IRA. There's a beneficiary designation form where you pass this along to Skidmore College, and it's very easy. You can do that in the comfort of your home, and you probably need our tax ID number, which we'll have for you. It's on our website, or you can contact me directly. But there's a tax benefit to that, and the tax benefit is essentially if you give an IRA or some sort of retirement account to your heirs, they're going to pay income tax on that as they receive those monies. Whereas if you give them to Skidmore, we're a nonprofit organization, so there's not going to be any tax. So if in your estate planning you have a choice, you want to support your heirs and Skidmore, the best asset, frankly, to give to the college or other charities is a retirement account because of that tax benefit. And then give your heirs something that's not going to be taxed, eaten up by tax. Just makes more sense. Commercial annuities, the same thing. When you give them to heirs, there's taxes involved, whereas if you give those to Skidmore, we're a nonprofit, no taxes are involved. Donor advised funds is sort of a giving bank account with places like Fidelity and others where you put money in there, you get a tax deduction out of that when you put it into that fund. And then throughout the year or through the years, you can say, I want Skidmore to receive $2,500 or whatever. At the end of your life, there's going to be money, or there could be money in a donor advised fund. Well, you can actually use a form to designate whatever remainder is towards your favorite charity. And so that's a beneficiary designation that's easily done. And same thing with life insurance. So all those gifts right there can be done without the use of a lawyer. And in fact, those documents, a beneficiary designation form, take precedence over anything that you have in your will or your living trust. So the administrators are obligated to follow your directions. Okay, next. So the last area that I wanted to cover is income generating gifts. How do these things work? Well, you donate cash, appreciated securities, or real estate to the college. And then what you get for that is, first of all, you get a partial income tax deduction. And you may be wondering, well, why is it only partial? Well, the reason it's partial is because you're going to be receiving money back. And so you don't get the full value of that. The deduction is not the full value of that property or cash because you do get that money back. For planning purposes in general, maybe it's about half. It just depends on your age and how much you're receiving back. But in general, you can think half. So if you give, $10,000, you might get a $5,000 deduction. But again, it depends on your age and how much is being paid back to you. You do receive payments for life. And so that's a reliable stream of income. We'll talk to you. I'll tell you about, your options there. And then your remainder, whatever's left over after your lifetime, goes towards whatever you want your designated charitable purpose, a scholarship fund, for example. So there are two payment options. One is a fixed payment known as a charitable gift annuity. And then there's a variable payment, which is a fixed percent of the value. And that's called a charitable remainder unit trust. So let's look at those a little bit more in detail now. So for the fixed payment option, the charitable gift annuity, or CGA as we call them, you can either start payments immediately, or you can actually defer the start of the payments to you in the future. At the time you make your gift, you get a charitable income tax deduction, if you can use that. Many people don't itemize these days, but if the gift is big enough, you might find yourself itemizing. So your payments can start now or in the future. You can have one or two income beneficiaries. Typically, it's the donor and the donor spouse would be the beneficiaries. And then the rates, as I mentioned, are based on your age. The older that you are, the higher your rate or the higher amount, the amount of your payment. You will receive a significant amount of tax-free income. It's possible if you fund your gift with cash, and many people do. I'll go through an example in just a minute. Your payments are guaranteed by Skidmore's endowment, so a very secure source of income to you. And Skidmore has a minimum of $10,000 for these gifts and age 60. You have to be at least 60 years old. So let's look at an example. And these are sample One Life rates. So if a person is 60, you can see that their rate is 4.9%, which means, for example, if they were to give $100,000, then 4.9% would be $4,900 per year for life. And that amount would not change, $4,900 per year for life. An 80-year-old at the bottom there, their rate is 7.6%. So if they gave $100,000, they would receive $7,600 per year for life, never change. And then the next column there, the tax-free income, if your gift is funded with cash, then for a 60-year-old, 52% of that payment would be tax-free for the rest of their life expectancy. If a person lives beyond their life expectancy, which sometimes, actually, we feel like when people make these gifts, we think that, they might live well beyond their life expectancies. It's just kind of a funny thing that we like to say. You make this kind of gift and you'll live 20 years longer than what you expect. But anyway, 52% if your income is tax-free. For an 80-year-old, you can see that the amount of tax-free income for the life expectancy is greater. It's actually 71% of the payments that they receive will be tax-free. And the charitable deduction amount is 39%, and it goes all the way up to about 49% for an 80-year-old. The rates do increase actually beyond age 80. And of course, they're a little bit different if you're between any of these brackets there. But this gives you a sense of what some of the rates are. The rates would be slightly less for 2 lives, but we can certainly give that to you if you're interested. Okay, next. This is something new. An IRA-funded charitable gift annuity. For years, people have wanted to know, can I use my IRA to fund a gift annuity? And the answer has been, well, you could, but it doesn't make much sense financially because of the taxes. Now, effective in 2023, actually January 1st of this year, you can do that. And there is a sort of $50,000 lifetime maximum, meaning you can see the second bullet, one and done. You can do this 1 year only. You don't have to do it this year. You can do it next year. You can do it in 3 years. But once you make a gift like this, that's it. So it makes sense if you can to max it out at the $50,000. That amount, by the way, will be indexed for inflation in the future. And I think the amount next year, it's currently $50,000, will go up to $53,000. Don't quote me on it yet. It's not official, but I understand that it's going to be going up to $53,000. So the way it happens is it's a qualified charitable distribution, just like if you were giving an outright gift from your IRA to Skidmore, you would actually make a similar qualified charitable distribution, meaning it comes straight from your IRA to Skidmore. It does not increase your taxable income, and it counts towards your required minimum distribution, which is a beautiful thing. There is no charitable income tax deduction for a gift annuity like this because your taxable income doesn't go up. So the government's just not going to give us double benefits from that. But there are some good tax benefits, which I'm going to cover in just a minute, which is sort of this last bullet. Your annual payments are taxed as ordinary income, which is in fact much better than if you were to receive the entire IRA withdrawal, because that would be fully taxed. So let's look at an example to show you what that means. If you took a $50,000 required minimum distribution from your IRA outright, let's compare that with actually using that $50,000 qualified charitable distribution to fund a gift annuity. This example is for a 76-year-old who's in the 32% income tax bracket. So if this person takes a $50,000 required minimum distribution, the entire amount, the increase in the income is $50,000. And because they're in the 32% tax bracket, they're going to have to pay $16,000 in tax on that for the year that they take it. Now, if on the other hand, they put it towards funding a charitable gift annuity through a qualified charitable distribution, the income increase from their required minimum distribution, which they get credit for that, there is no income increase. So therefore, you're not going to be paying that $16,000 in tax. The only tax that you'll pay is on the income that you will start receiving from your gift annuity, which in this case, the rate for a 76-year-old is 6.8%. So their payment would be $3,400. So the only thing that's taxable is that $3,400, and based on that tax bracket, it's just under $1,100. So you can pick $16,000 in taxes or under $1,100. It's really a great tax benefit. So I wanted to point that out. It's brand new this year, and if you're interested, be happy to talk with you a little bit more about that. We're getting definitely some interest in that right now. Had a conversation just the other day. We had shown this to one of our donors maybe a month or two ago, and they said, I'm not so sure I'm interested in that. Well, right now it's time for these folks to take the required minimum distribution, and all of a sudden they're like, what was that thing? And so we've had a serious conversation. I think they're going to go forward with it because of this benefit right here in this slide. It just makes a lot of good sense tax-wise. So I think we'll move to the next slide. For variable payments, that's fixed payments, that's gift annuities. For variable payments, we have a thing that's called a charitable remainder unit trust. And it's ideal for highly appreciated stock and securities. And I say it's ideal because if you put highly appreciated stock or highly appreciated real estate into a charitable remainder unit trust, the trust can sell it and it will not pay any capital gain tax. Whereas if you sold it, you're going to be realizing a capital gain, and depending on your circumstances for real estate, but certainly for appreciated stock, you're going to have some tax for sure. And so you can avoid that tax by using a charitable remainder unit trust, and then you will receive payments for life, and it's a fixed percent of the trust assets as revalued annually. For example, if you put $100,000 worth of highly appreciated stock into a charitable remainder unit trust, and it's a 5% trust, you will get 5% of the value of that trust paid every year. So in your first year, 5% of 100,000 would be $5,000. If the trust goes up in value to 110,000 after the course of 1 year, your payments next year would be 5% of 110,000 or 5,500. Of course, the opposite is true. If it drops down to 90,000 the next year, your payments are going to be 5% of 90,000, so it would be 4,500. Generally, these are better for people that have a longer time horizon and want a hedge against inflation. While the markets go up and down, we know they do over the long haul. There's a better chance that you will be able to keep up with inflation with these types of payments. But as I said, they're great for highly appreciated assets. You get a very nice charitable income tax deduction and a good source of income. So we can look at individual examples if you're interested. I'm happy to do illustrations of this with you. And I don't know if we have any more slides. I guess we're sort of at the closing here. I think we're ready for questions at this point. Not going to close right yet, but I think we may have some questions.
We do. Thank you, Art, so much for that terrific overview of gift planning options to help our alumni, parents, and friends of the college achieve their philanthropic goals to support Skidmore. Really helpful. We'll now move to questions. And our first question is, I already have a will and I don't plan on revising it for several more years. Is there anything I can do in the meantime?
Absolutely. And I understand, you don't want to run to your attorney every time you turn around. And so that's a great question. Generally, people go when they have life, major life events. So that makes perfect sense. Yes, the answer is that you can update your beneficiary designations. As I said, on retirement accounts, on life insurance policies, on commercial annuities. One thing I didn't mention is that if you have bank accounts, you can actually do a designation on that. I think they call it a transfer on death form. That's available at your bank. So there's a lot of different things that you can do to plan a gift to Skidmore, and it's very easy, just filling out a form.
Great. We do have another question. I own some long-term, highly appreciated stock. Is it better for me to sell the stock and donate cash, or should I donate the stock?
Yeah. So, of course, I just want to point out that you want that stock it's not held inside of an IRA or other type of retirement account. But the only time you would want to sell a stock and give us money is if that stock has actually gone down in value. So you bought it for, say, $1,000 and it's gone down to 900. It makes sense for you to sell it, have $100 capital loss, and you can put that on your taxes. It'll help you with your taxes. But if it's gone up in value, you definitely do not want to sell it and give it to us, because you're going to have a capital gain tax. It's much better just to transfer the stock directly to Skidmore, and then we can sell it. And it's really a great way to give. As I mentioned earlier, it really is it's more cost effective for you to give. It reduces the cost of your giving if you give stock. And you have the benefit, if you ever want to rebuy that stock with cash, you can buy it at the current market value. So then you eliminate a capital gain inside of your portfolio. So, yep.
Terrific advice. Thank you. Next question. I don't need the required minimum distribution from my IRA because they only increase my taxable income. Do you have any suggestions?
Well, sure. You can give it outright to Skidmore through a qualified charitable distribution. As I mentioned, it's very important that you work with your IRA administrator on that. They will arrange a direct transfer from your IRA to Skidmore. Since you don't need that income, you can give that to us through your IRA administrator through a qualified charitable distribution, and you get credit if you have required minimum distributions. I'm not sure if that's your circumstance or not, but probably is, because I'm sensing that you have to take this. So yeah, you'll get your RMD credit, and your taxable income is not going to go up. Those are wonderful gifts, and we do receive quite a few of those. Real smart way to give. And if you have that situation, as I mentioned, from other types of retirement accounts, 401ks, for example, you can roll that money into an IRA and give this way. It's really a great way to give. We've got information on our website, or just contact me.
Great. Thanks again, Art. Next question. So I'd like to make a significant gift, but I can't because I'm retired and living on a fixed income. Plus, my stocks and other investments have been paying low dividends for years. Do you have any suggestions?
So yeah, I mean, stock dividends may be going up a little bit, but I understand the question. Yes, you can, if you have enough assets to take care of healthcare and other needs that you have, you can use your stock to fund, depending on the amount, a charitable remainder unit trust, which will pay you a fixed percent every year, or you can do a gift annuity, which will pay you a fixed dollar amount. And it's really it's very easy, and we're actually seeing quite a bit of more interest now in charitable gift annuities. The rates have risen significantly over the past year. So contact me. I'll be happy to talk with you about that.
Terrific. Thank you. We have a clarifying question. So if I make a QCD at age 70 and a half, does that count towards the required age 73 required minimum distribution? Who tracks that if this is the case?
So if you haven't reached the age of 73, then you're not required to take a distribution. However, so you don't have to take that distribution if you're not 73 yet. That's the rule. However, if you do want to make a significant gift to Skidmore from your IRA through a qualified charitable distribution, you can do that as long as you're age 70 and a half or older. So there's sort of that little age between 70 and a half and 73 where you don't have to take this money. But if you want to do something at Skidmore and make an impact with your giving, you can do that. And you can take advantage of that. It's not going to raise your income. It's not going to count towards a required minimum distribution because you don't have one, but it's not going to raise your income either. So you can do something if you feel like, well, I have enough in my IRA, I'll be okay, but I want to make this gift for my reunion. You can do it, and it's not going to raise your income and your taxes. Hopefully that answers your question.
Great. Thanks, Art. Here's another question. So I don't need the required minimum distribution from my IRA this year, but I don't feel comfortable donating it to Skidmore either because I might need this money in the future. Do you have any suggestions?
Yeah, that's actually this scenario that I was speaking with a donor earlier this week. They just don't want to give that IRA or required minimum distribution outright to the college because they feel like, well, I might need it, but I want to do something. So that's a perfect example or a scenario where somebody would fund a charitable gift annuity with their IRA. And the key thing is that make sure your administrator makes that distribution to us, and of course, let us know ahead of time. And then you'll have a nice income tax, you'll have a nice income stream coming to you for life. So you don't give up the asset totally. You actually get a nice income off that asset.
Great. Another great question. I was going to give my vacation home to my children, but they are doing very well and don't really need it. What are my real estate giving options?
Sure. So I've worked with donors in this exact scenario. You know, the vacation home works great for a number of years as the kids and the grandkids get older and they start living their own lives. And so the kids and the grandkids aren't coming around so much anymore. And this house, frankly, becomes a bit of a headache, and because you've gotten the maintenance and taxes and everything. So I've worked with donors exactly in that type of situation. There's a couple things. I mean, you could give it outright to the college. People are sometimes reluctant to do that. We definitely accept gifts like that, and they're wonderful gifts. But if you feel like, well, I want to retain this just in case, well, you can do a retained life estate where you continue owning the right to use the property, but you get a nice income tax deduction, but you can continue to use it. And if you later on decide, you know what, I thought I was gonna want to use this, and that's why I retained life use. I don't really think I need it anymore. You can actually donate the property fully, your life use interest. You can actually donate that further on down the road, and you'll get another income tax deduction. So there's a number of options. There's also a thing called a gift of an undivided partial interest in the property, where you give us a percent of the property, and you can do that every year. Whereas we start owning more and more of it. A little more complicated than what I want to get into on the call, but there's definitely options for you. Contact me. I'm happy to walk you through and see what makes sense for you.
That's great. Thank you, Art. This is our last question. My professional advisor hasn't mentioned gift planning. Is this something I should bring up?
Absolutely. Sometimes professional advisors, particularly people that get paid based on the amount of money that they are managing, are not so keen on seeing you part with it. But I definitely would talk to your professional advisor. Sometimes attorneys don't bring it up either. But just tell them, hey, Skidmore is really important to me. What are some ways that I could support it through my estate or otherwise that makes sense for me in my situation? I'm not an attorney, don't claim to be one. And so I really don't want to be in the situation where I advise you on what's best for you. And so that's really why you have professional advisors. But if they're not bringing it up, tell them that's what you want to do, and they'll help you explore your options. And they can always bring me in, and we do have sort of conversations, three-way conversations between myself, attorneys or financial advisors, and donors. We do that.
Terrific. Art, thank you so much. And thanks to each of you for participating in today's gift planning webinar. As you think about the impact that you'd like to make at Skidmore with your gifts. We'll be sending a video recording of today's session via an email soon. And we'll also be posting this recording on the Skidmore gift planning webpage, which is myimpact.skidmore.edu. So you can refer back to this information as often as you like. As a reminder, Art is available to answer your questions by phone, email, Zoom, or in person. Again, thank you all so much for your attention today, and thank you, Art, for your time.
Welcome.